Good afternoon and welcome to Charting Points, a technical look at ag markets. My name is Brian Como. Today is October the 17th, and it's a Tuesday today, October the 17th. All right, we'll get into the disclaimers right away here. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material provided is as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability is therefore expressly disclaimed. Prior results are not necessarily indicative of future results. All right, we're going to get into the crush story. I left this off of the morning commentary today because I wanted to talk about it a little bit more in depth in this video today. So we're going to talk a little bit about the U.S. soybean crush. It came in at 165.4 million bushels this last week. That is, when you look at it from the this charting standpoint, that doesn't look super impressive. I mean, it looks like it's just coming off lows. But actually, it is a pretty impressive number. As you can see here, this gray circle here is the seasonal crush for this time of year. As you can see, we normally see a drop off here in this time frame, because this is the period of time when seasonal stocks of soybeans are low because the old crop soybeans are reduced significantly and the new crop ones aren't necessarily online yet. So we tend to see soybean stocks low at this time of year, and that pushes crush lower. However, this year, I think this is a high for the month of September, a historical high for the month of September. And as a result, we are seeing a positive change in the soybean market today. All right, just kind of looking also at some of the other statistics inside of the crush report. U.S. soy oil stocks are at their lowest level that we've seen in the last 9 years. This is a 5-year chart. It already looks extremely low at this point at 1.1 billion pounds. But when you even pull back to a 10-year, as you can see here, the reason it's only a 9-year low is because we did see a push lower in Q4 of 2014. But other than that, soy oil stocks are extremely low in the U.S., and that is also a bit of a bullish input, particularly for soybeans, although we didn't see necessarily the same reaction that we did out of some of the other markets. So here is the soybean board crush margin. It has expanded significantly from under $130 a ton to above 169. So we are seeing some positive push up in the soybean board crush margin. Interestingly, though, when you look at the soybean oil stocks, you'd think that that would be the major driver. But actually what we're seeing is the driver being soy meal prices. At this point, we are pushing up towards $400 a short ton now. And as you can see, if we can clear this level here, this is the 200-day moving average. If we can move above that level, I think that gives some further upside, possibly into the 420 mark. And I think soy meal at this point in time is a larger driver of soybean prices than oil is, or they kind of flip-flop. But as we're seeing right now, this is a bit of a driver for overall, not only for crush margins, but also for soybean prices as well, because the two, of course, are linked. Just to kind of show you the difference between soy meal and soy oil. We are seeing soy oil values push higher as well. It is moving towards the 20-day moving average, but hasn't cleared that yet. It did move above some trend line resistance, which is nice. It did bounce here, as you can see, off the 61.8% Fibonacci retracement level, which would have been a retracement of the rally from the end of May into the middle of July or the end of July. So that's a good strong bounce off of some key support there, and now a move above trend line resistance, which is good, and it's now threatening the 20-day moving average. So if we can move above that, I think we also have the opportunity at least to move it back up into this 60.5 cents per pound mark, which would again put some support into soybeans proper, as well as some of the other oilseed markets as well. Speaking of some of the other oilseed markets, Canada's crush is also performing extremely well. In the first week of October, canola crush in Canada was reported at 228,765 tons. That was 97.7% of total capacity, which is just an amazing number. That did back off into the second week of October, but we are still seeing 90 plus, or a little bit over 91% of crush capacity utilization, and over 213,000 tons crushed. So we've just seen a good overall performance in the Canadian crush market here. And as you can see, we're crushing above average, even with at least currently projected production, under 18 million, although I think there are some numbers that are pushing that production up towards 19 at this time. You can also see that there's a bit of a bounce happening in the vegetable oil complex when we're talking about cash markets in China. Canola oil has rebounded about $86 recently. We've seen about $34. This is all US dollars as well in soybean oil, and a rebound in palm oil. So we are seeing vegetable oils in China come off their lows, which is a supportive element to the vegetable oil complex as well in the last that's been in the last week or so since about the 9th or 10th of October. Canola board crush margins are also advancing. It did move lower. As you can see, it didn't move significantly lower to the point where it was threatening to be zero or where plants were operating at a loss. But I do think that this area here, when we saw this surge, I think some additional business got booked. That could be why that 97.7% was clocked in at the beginning of October, was crushers taking advantage of that piece of the board crush margin rally. We are seeing it now come off its lows. It came down to about $123 a ton in margin and is back up to $143. Whichever way you spin it, these are still positive numbers. I think that there isn't anything to dissuade the crush from crushing at this point. But once, I think the signal here is once we get up into this 150 plus area, so if this can muster a rally up towards 150, I think that'll incentivize more crush to get booked, at least on paper, and that will help to bolster or continue to bolster the crush market in Canada. Here's what futures look like for January canola. We are trying to watch this market kind of trade above the 20-day moving average. So far, it's failed to do that. We did see a hard test here on the January of that 61.8% Fibonacci, so a similar pattern to soybean oil and soybean meal and those types of markets as well. So if we could start to muster a move above that, that would at least give us the opportunity to take us back up into the 750 area. If it can move past that 20-day moving average. You can see we haven't really been up above that 20-day moving average, and we only were there for a short period of time in the end of August when we see this kind of seasonal rally happen here. We do normally see seasonal rallies in the month of October, so this isn't out of sync with seasonal timing, so we could see a bit of a push. At this point, it would be hard to muster anything more aggressive than a test into the 750 area, though. So we do want to keep kind of expectations tempered, and I do think that there is going to be a lot of selling pressure in this market if the market does rally up there. So again, we advocate for using target price orders, or even specifically futures target price orders, as opposed to cash market target price orders, but both of them will work well in markets like this when you're trying to take advantage of rallies like this. Some of the other vegetable oils as well, we are seeing palm oil see some expansion as well. As you can see, it hasn't made a new high yet, so it's hard to kind of call this bullish. But one thing I do like about this market is, as you can see, all these moving averages kind of converged. And again, convergence of moving averages kind of signals towards a neutral market. We could still be locked in a neutral market. Maybe this high at around 3,800 ringgit is where it might pivot again and come back down. Not that we know that yet, but if we do muster trade above this 200-day moving average, and we see some sustained closes above that, I think that there is some room to move it. If not to 3,800, then maybe even into this 4,000, 4,100 area up here. So we could see some positive gains in that market. We are in the throes right now of the largest part of the or the largest production seasonal production area of palm oil. It's going to diminish as we move through the month of October and into November, but that doesn't mean it goes to zero. It's just the end of September and the beginning of October are seasonally the times when production ramps up, and so we're kind of working our way through that now. As we move into some of the grain markets as well, I want to talk a little bit about corn. Here's the this double test of the $5. I think I've mentioned this in a couple of the morning commentaries and things like that, but $5 is one of those areas. It's not necessarily a technical level, although we did see a high here at the end of August test that level and then fail, and then we've seen it test that level and fail twice now. It's more of a psychological thing, I think, in my mind, than it is a technical, because really the technical previous highs were at about 506, 507. So if we can muster a move above this $5 area, I think it does give us some headway to move higher, although it might be a grind. And I still think that this corn market might be kind of locked into a neutral status at this point in time, with about 470 being the bottom and $5 to 510 being the top. So any trade in there, I would consider neutral. If we can move above, this is the 100-day moving average up here. If we can move somewhere into here, that would kind of give me more confidence on a more sustained bullish move that might make up for some of the losses that we've seen through the growing season. So just keep an eye on that. Still kind of more neutral corn, but watching some of those resistance levels for some bullish signals. Kansas continues to be weak, or the weakest, at least technically, from the other wheat classes. This is largely because there is intense competition from the Black Sea and even from Europe and other Black Sea countries other than Russia, such as Bulgaria, Romania, etc. Still being products still being dumped at discounts onto the market in order to get it sold. I've seen estimates now of the Russian crop above 90 million, 92, 92 and a half. USDA is still down at 85. I think they're lagging. I think they're probably wrong, and they're probably going to need to adjust that higher as time goes on. But this market continues to see pressure. If we start seeing breaks below 660 again, that might be a concerning move for the wheat markets, or at least for the hard wheat markets. Minneapolis taking it a little bit better. We did see a bit of a head fake or a reversal today as the Minneapolis market moved up and tested this 200-day moving average at about 737, 738. But then failed, and we actually closed the day on a loss down to 726 or so. And so again, this market is struggling. The wheat markets are struggling. I think in Canada there's some benefit happening because of the falling Canadian dollar, and maybe marginally higher futures is making basis look more attractive. Couple that with the fact that wheat's one of the only exportable commodities in Canada, so I think we are seeing some elevated basis moves in the wheat market in Canada. That isn't necessarily indicative of the global S&D, though. So just keep that in mind when making wheat decisions. I do think it is important also to continue to use cash market or to use target prices when pricing your cash, and then using other ways, whether it's brokerage or OTC contracts or whichever way you choose, to utilize upward momentum on the wheat markets. And the good thing is you probably have the ability to wait on that until it starts giving you some better bullish signals. Right now, I'm not looking at this and seeing a whole lot of bullish response on this wheat market yet, particularly if we look at Kansas. The one wheat market that is showing a little bit more positivity, or at least a little bit more signs that it's trying to bottom, is the Chicago wheat market. As you can see here, it did move above the 20-day moving average, although today, again, in a bit of a reversal move, it closed lower by about a nickel and below the 20-day moving average. So that's a bit of a concern. Still think this is probably more neutral than it is bearish at this point, but that is what is happening in Chicago. It did get a bit of a bolstering when tensions were high in the Middle East. Well, they still are high, but when there was more unknowns immediately following the attack that Hamas executed on Israel. So the other thing that soft red winter wheat has going for it is the large short position as of I guess that position would have been last Tuesday. So this would have been a week ago's position, 104,000 contracts short. It is a pretty large net short, which does open that market up to short covering if something does trigger that market to cover some shorts. As you can see here, the hard red spring and hard red winter are also kind of getting into that category. So it doesn't look as aggressive as soft red winter, but as you can see here on some of the historicals, hard red winter is getting into that area where it is short versus history. So all the wheat markets are now getting to that point where they have large short positions relative to history, which does open those markets up to short covering. But we probably need to see some kind of catalyst in order for that to happen. Otherwise, the traders are just going to sit on those short positions and collect their dividends and until there is a warning sign or some reason for them to exit this market. Oats was interesting today. A big reversal today on oats. It looked like the market was trying to snap back out of some of the funk that it saw earlier. We did see it did result in a complete reversal and posting of a new low down near 370. Again, I don't think I have a complete up-to-date closing prices in these charts, but they were close enough. It did close at a new low today. These other days snapped below this level, but never closed that low. So today we punched a new low in the close, which again is a bit of a bearish signal. We did put out a sales recommendation. I think it was early last week. It was either early last week or late the week prior. All these days are blending together now. But we did put out a note recommendation recently because the futures were showing weakness and the cash prices hadn't responded yet. So there was an element of take the risk off while you can see it happening before you see too many losses in the cash market. And I think this shows us that there still is risk in this market. All right, lastly, I did want to talk about a non-grains chart here. Here's the U.S. 10-year note yield. Now, it looked like the market had kind of backed off from its highs recently as we moved into the beginning of October. Today, we saw it march significantly higher back to about 4.8% yield on the longer term or the 10-year. The other lengths are the 2-year and so forth are also seeing similar gains. But this still shows that there is significant risk in the markets as far as inflationary pressures, even though Canada's print today was a little bit better than expected, or better as far as lower inflation than expected. But we're still seeing pressure from the U.S. To push 10-year notes higher, which does create a bit of a risk potential in the market. So I just wanted to note that as well as those yields march back towards the 5% mark. All right, that's all we had for you today. Thank you for joining us. We will see you again next week, we'll see you again on Thursday. Have a great week, and we'll see you again.